What's up guys, I'm Paul and welcome to the channel. So I'm going to make a quick assumption here, and that is you've realised you've got £100 sitting in your bank account at the end of every month that's just sat there doing nothing, and saving money at the moment isn't really that great because interest rates are abysmal, and you want to start making that money work for you, but you're not sure what kind of things you can invest in. And that's why I'm going to assume that's what's brought you to this video. And in this video, I'm going to go through and explain how you can get started investing in the 4 major asset classes with just £100 a month. So hopefully it will inspire you to go on and start your investing journey, because honestly, it's an awesome journey to start. But before I get into the video, I do just have a quick disclaimer, and that is that this isn't financial advice. I'm not a financial advisor, I'm just a guy making videos for YouTube. But hopefully there will be something in this video that will give you kind of inspiration as to how you can think about getting started. But you do need to do your own research or speak to a professional before you actually make any investments, just to make sure that they are the right things for you. Just need to get that disclaimer out there. So let's get on with the video. So the first thing we're going to talk about is investing in the stock market. And for the majority of people, the best way to get started is probably going to be buying index funds. Now, if you're not sure what an index fund is, it's a fund that's designed to track the performance of a specific index. Now, these can be country ones such as the UK or the USA. You can invest in regional ones such as Europe or Asia, or you can invest in the whole world if you want by buying a global fund. And there's a few reasons why these are such a great option for new investors. The first one is diversification, because you're buying into potentially hundreds or even thousands of different companies, which means you're getting access to lots of different sectors. And if you're buying something like a global fund, you're also getting access to different markets all around the world. It just gives you massive diversification in one single fund. The second one is that easy to buy, because you just basically choose the fund that you want to invest in and put your money into that every single month. It's not like when you're investing in individual stocks and you've got to do kind of financial analysis on those companies to see if they're either undervalued or they're going to perform potentially better in the future. You don't really have to do that. You just need to pick the market that you want to invest in, put your money into it every single month, and basically invest and forget. It's a very passive way of investing. And number 3 is the low fees. Now, whenever you invest in an index fund, you're going to have to pay a fee for people to manage that fund. And this is known as the OCF, or the ongoing charge figure. But because index funds are pretty passive in the way they're run and the way they're managed, it means that they usually have very low fees. But this fee does depend on the fund you're investing in. And if we look at Vanguard, for example, we can see on their funds that they range from 0.06% to 0.29%, which is really low and a lot lower than actively managed funds. Even with Vanguard, the actively managed funds start from around about 0.48%. But with other platforms and other funds, these can be considerably higher, and some of these are over 1%. So the fees for using index funds are usually really, really low, and this means there's more money in your portfolio rather than in somebody else's pocket. So hopefully this will mean that you get more money in the long run. Now, when you're looking at index funds, you may see that there's index funds and also ETFs that seemingly track the same market. And you may be wondering, what's the difference between them? Well, they are quite similar in the way they operate, because they're both designed to track the performance of that specific index. But the main difference is the way these two things are traded. With index funds, they're traded once the markets close. So basically, once everybody else has finished trading, all of the trades for the index funds are then processed. So when you place a buy order for that fund, it'll either be processed the end of trade that day or end of trade the following day, depending on when the cutoff time for that fund is. ETFs, on the other hand, which stands for Exchange Traded Fund, are traded live on the stock exchange. That's why they call it exchange traded funds. And this is why at the end of every single ETF, when you see what the ETF's called, you'll see a 3 to 4 letter ticker symbol. And this is what's used to identify this fund when it's traded on the stock market. So this is basically the main difference between these two, is when they're actually traded. There are also some other smaller differences, but that's the main one that you need to be aware of. Now, when it comes to choosing an index fund, that is completely down to you, because you need to choose which market you want to be invested in and then find a fund that matches up with that market. It's as simple as that. You just need to decide which markets you want to be invested in. So the second asset class we're going to look at is property. Now, I'm not saying you're going to be able to go and buy a buy-to-let property for £100 a month. I think those days are well and truly gone. But you can still invest in property for just £100 a month by buying what's called a REIT, or a real estate investment trust. And these are pretty interesting in the way they work, because basically what they do is they pull all of their investors' money together and then go and invest that in property, with the aim of that property doing one of two things. Either they're going to rent it out so it becomes an income bearing asset, or they're going to sell it on for a profit. And the best thing about this is you get to own a small percentage of these properties without any of the hassle of actually owning that property. So you're not having to worry about actually buying it, all the red tape that goes with buying property, and also things like development costs as well. That's all covered by the company managing that fund. You're just putting the money in and then they're using it to buy properties. Now, one of the reasons why certain investors like REITs is because they usually have really big dividend payouts, and they can range anywhere from 4 to 8% from the ones that I was looking at, which is massive. It's way bigger than what you get from most index funds. So if you're wanting to build something like an income bearing portfolio, they may be something that you want to consider. But there is a big trade-off with this, and that is the ongoing charges are usually quite high. Most of the ones that I saw range from 1 to 2%, which is considerably higher than the index funds that I just talked about. So it's kind of a trade-off between dividend income and also paying more for actually investing in those REITs. So if property is something that you want to invest in, but you haven't got the money to actually go and buy a physical property, these are something that you might want to consider. But once again, do your research into the REITs before you actually invest in them to make sure that they're actually something that you want to invest in. So the third asset class is precious metals. Well, in particular, gold. Now, some people don't like gold as an investment, but other people do like having it as part of their portfolio. And you can get started investing in gold for £100 a month. Now, when you're looking at £100 a month, I wouldn't be looking at physical gold. The reason is you're only going to be buying a small amount. In fact, if you're investing £100 a month, you'd only be able to buy 1 gram of physical gold a month. And this is the most expensive way of buying it, because the smaller the amount, the more you pay per ounce. It's much better to invest in larger actual amounts of gold because the price per ounce does come down. And really, if you're looking at physical gold, I personally would be looking at nothing less than a sovereign. But you can invest in gold digitally, and you can do this either by an ETF or an ETC. Now, you're wondering what these letters are. ETF, as we know, is Exchange Traded Fund, and this is where you have a gold-backed security traded on the US stock market. But gold-traded securities that are traded on the UK stock market, and also things like Europe as well, are called ETCs, which stands for Exchange Traded Commodity. And that makes sense because gold is a commodity. Now, the way these funds work, I'm going to call them funds in this video because it's just easier for me, is when the value of the underlying asset moves, so if gold prices go up or down, the fund tracks this movement. So if gold prices go up, the fund price goes up, and the reverse, if it goes down, the fund price goes down. And also with these funds, for every pound that's invested, there's meant to be a pound's worth of physical gold backing that investment. Now, whether or not this is the case is somewhat debated, and there has been some controversy around this in the past. But as an investor, you don't really need to worry about this. You just need to be thinking about how you're going to be investing, and is the value of that asset going to go up over time. So once again, you need to put your research in and basically clue yourself up about gold. Now, I do just want to take a quick second to talk about how to invest in the assets that I've just talked about, and also the kind of accounts you can use to invest. Now, when it comes to investing in them, you need to use a brokerage, and it's going to depend on what you want to invest in as to which brokerage you want to use. So if you just wanted to invest in index funds, you could look at something like Vanguard, but they only trade Vanguard funds. But things like Freetrade and Fidelity have a much wider range of investments available, including REITs and also ETCs and ETFs for gold as well as many different kind of index funds and things like that. So it does depend on what you want to invest in as to which one is going to be the best brokerage to go for. Now, when it comes to accounts, you could get started with something like a general investment account, but this doesn't offer any tax advantages, whereas an ISA, which is an individual savings account, does offer some really good tax advantages when it comes to investments. Because when you invest through an ISA, number one, you don't pay any income tax on dividends. Number two, if your investments grow and you sell them on, you're not liable for any capital gains tax. And number three, you can invest up to £20,000 in an ISA per year.
Nice.
And you may be thinking, but Paul, I'm only investing £100 a month. And you're, yeah, that's £100 a month now, but hopefully that investment is going to grow in value massively over the years. For example, if you started investing in January 2002 and you put £100 a month away up until January 2022 in the S&P 500, your investment would now be worth around about £89,000. which is a lot of money. And if this was invested through an ISA, you would have that protection of not having to pay income tax or capital gains tax. So it's something you do want to look into as to which account you use, but say for most people, a stocks and shares ISA is probably going to be the best way to go. So the fourth and final investment class we're going to be looking at is crypto, which is of course the riskiest and most volatile one of the list that you can invest in. But lots of people are getting more and more interested in investing in cryptocurrency every single year. So I thought I had to include it in this video. Now, when it comes to getting started investing in cryptocurrency, you do want to try and mitigate your risk as much as possible, which is very difficult to do in cryptocurrency, by the way. And that is why for most people, it's probably going to be best to invest in the two biggest names out there, which are Bitcoin and Ethereum. The reason is these two coins are pretty well established now. They've been through lots of ups and downs, lots of dips in the market, and they seem to be surviving. They also have some real world uses as well, which is adding to the legitimacy of both cryptos, which is going to be a benefit in the long run. And also, as they're becoming more established and more mainstream, the volatility is somewhat dropping, and that is relative compared to other altcoins, because some altcoins are having massive fluctuations like hundreds or thousands of %, whereas that is somewhat falling when it comes to the two biggest ones out there. The ups and downs, even though still massive when compared to things like regular stocks, aren't as big as what they used to be. They are starting to become somewhat less volatile. Now, when it comes to actually buying cryptocurrency, you're going to need to use what's called a cryptocurrency exchange. And there's many out there, but one of the best ones for beginners is Coinbase. The reason why, it's pretty easy to use and they have a good selection of coins on there. The one big downside is the fees can be quite high, but say it is quite easy and beginner friendly to use. Now, if you'd like to get yourself $10 worth of free Bitcoin, you can do using my link in the description to sign up to Coinbase. And when you sign up and you buy $100 or more worth of crypto, you'll get $10 worth of free Bitcoin. So that's a win-win for everybody. And the reason why I'm saying dollars and not pounds is because the currency rate fluctuates every single day, and the price I say in pounds today might not be applicable whenever you're watching this video. So I'm just going to stick with dollars because it's much easier. Now, unfortunately, there are currently no tax efficient ways of buying cryptocurrency. There's no way you can buy it through an ISA. So when you're buying crypto, if that goes up in value and it goes up in value a lot, you may be liable for capital gains tax. Also, if you move it to somewhere where you're generating interest off your crypto, you may be liable for income tax on that as well. But make sure you check with a financial professional before you submit your tax return, just to make sure you're paying the right amount of tax. As I say, this isn't financial advice, and anything that you look at in this video that you're considering investing in, always make sure you do your research first. So I hope you found this video helpful and it's given you some ideas of how you can actually start investing with just £100 a month. If you have found it helpful, a like would be absolutely awesome. Also, consider subscribing to the channel for more finance related content. So thank you so much for watching. Stay awesome, and I'll see you in the next one.